Hello and welcome, What the Finance is, to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what is happening in the world of finance, investing, and markets. On today's podcast, I'm happy to welcome Joseph Hogue, our CFA, who's the founder of Let's Talk Money. So, Joseph, thanks for joining the podcast today.
Anthony, great to be here. Thanks for having me on. I know you're on vacation, so it's great to see you still working a little bit, even while you're having fun.
Yeah, people might notice I'm a little bit more tanned. I'm not as pale as I usually am, so I've been enjoying the sun over here. But yeah, Joseph, so I wonder if you can tell us a little bit more about yourself and I guess your background and how you've got into where you are today.
Sure. Well, I come from an equity analyst background, so after service in the Marine Corps and going to college, then I started with venture capital, private wealth management, that kind of thing, and just immediately fell in love with the idea of making your money work for you. Being able to put your money away, grow it over time, and that kind of thing. The thing that was missing, of course, was being able to talk with the people that I knew, right? Working in venture capital, private wealth management, and equity analysis, you're usually only dealing with the accredited investors or that top 1%. So in 2014, I knew I wanted to change that. I wanted to get back to Main Street investors and my roots. So I started the blogs, started the YouTube channel in 2017, and I just loved it, right? That face-to-face connection you get with video and being able to reach out there on YouTube. And yeah, I just love being able to take that professional experience of the markets on Wall Street and bring that to Main Street investors, talking about investing and how to make your money grow.
Yeah, I think I was listening to your live stream today, and you actually said that you have that bug. You just love analyzing companies, investing, and doing that stuff. So,
Yeah.
did you really just want to share that with other people?
Sure. Yeah, that's the big part of it. And it's weird. I actually just came off the live stream where I talked about this, where for the vast majority of the people, the easiest, best investing strategy out there is just index funds, maybe 10 or 15 stocks you really like, you want to hold forever. But for those of us that just love picking stocks and love following the market, it's a bit of a it's a bit of a trap, right? Because if you don't have a part of your portfolio that you can do that with, then you're just going to screw up the rest of your portfolio, right? If you don't have 10 or 20% of your money or your portfolio in stocks that you can buy and sell and you can pick and you can really follow the market and scratch that itch, then you're going to find yourself going into those long-term stocks, into those long-term funds that you want to hold, and you're just going to screw them up. You're going to buy them and sell them, and you're going to mess up that market return that you should be getting. So yeah, so one thing that I always love to talk about is how do you do that? How do you balance those market returns from the biggest part of your portfolio, but still keep some money aside to pick stocks and to have fun with it.
Yeah, and that's one thing that I think we all have to learn it, don't we? We start maybe trying to trade our whole portfolio, and I'm like, hang on, this might not be the best idea. Let's try and take a step back
Absolutely.
and do a small percentage. Is that sort of the lessons that you learned through your career?
Oh, and through my own personal experience too. And it's funny. It's as much, I've got more than 10 years of experience as a professional equity analyst and venture capital in that. But some of the best lessons that I can share and that I've learned just as a personal investor, my own investing experience. Started investing in 1999, which of course was a great year to start investing because we all know what happened the year after that. Uh, so I think I can relate to a lot of people that have just started over the last couple of years, have seen their portfolios just destroyed in the stock market crash, because I experienced that when I was starting investing as well. So, the things like, not only chasing those meme stocks and the growth stocks, but having some other investments in other companies and other themes and other trends as well. Things like, dollar cost averaging, but the risks of dollar cost averaging as well. Not having 20 or 30 or 40% of your money in one single stock, because if that stock, like BlackBerry, like Research in Motion, and like Peabody, if that stock ends up bankrupting, then you've lost all your money in that. So really, dollar cost averaging, but doing it smartly.
Yeah, and that's vital. And do you see many similarities, I guess, to today that as we saw in the dot-com bubble? Because I guess when I'm researching, it sounds familiar, but I guess what's your opinions on that?
Sure. Well, I think obviously, what do they say, that history never repeats, but it often rhymes, right? And I think you find that in so many different parts of the market, right? So whereas the economic backdrop is different with this stock market crash, the investors are the same. the investors right now are the same as I saw when I was starting investing in 1999. Right, we get excited about this new trend, this new theme in the markets. We bid up those kinds of stocks, like the pandemic stocks that we saw, and then when the future doesn't look quite as bright as it did for those stocks, then we panic and we sell out of them. And I think it's one of the best opportunities right now in those growth stocks that we've seen crash so hard, 70-80% over the last year, is that now they are still growth companies. Companies like Teladoc, companies like SoFi Technologies, even PayPal, which is quite a bit older than a lot of those other companies. They are still growth companies, changing the world in which we live. But now their valuations are so much more attractive. Back a year ago or 2 years ago, the valuations on these things that investors were paying, per share, per earnings, per sales, were just ridiculous. You could not justify those kinds of stock prices. And but now that the stocks have come down, then they are still growing companies, but they are also value stocks as well.
Yeah, I think if you look back at 2000, there were a few famous survivors, I guess, that made it through the dot-com bubble and now have thrived and taken
Oh
over the
man,
world. I feel like now, there's going to be similar companies, but I feel like there's a lot more companies that are actual companies. They're not just trying to make something. They do have that
sure.
earnings, they do have that revenue, they do have that growth. So there's probably a lot more opportunity to take advantage of it.
Sure, I think we have learned something from the dot-com bubble, right?
Hopefully.
Those companies that were just wildly unprofitable and weren't going to be profitable for a very long time. You still have some companies like that are unprofitable but are growth companies. And I mean the refrain on Wall Street and on YouTube and on CNBC is always, oh, you got to buy quality, right? That's always the disclaimer they use. You could buy quality stocks that are profitable, but I don't think you can really, you can't really just write off outright these stocks that are growing 20 and 30% sales growth, but are still unprofitable, on a per share basis. Because if you look at Amazon, one of the best examples after the dot-com bubble of Amazon, IPO'd 97, reached about $100 a share in 99, and then fell down to $6 a share. So 95% loss on it, from the peak there through 2002, and was still unprofitable, right? It was an unprofitable company, but we know what has happened to that company since. It's just last year before the split, it was upwards of $3,500, which would have turned $1,000 investment in 2002, just 20 years, into $500,000, right? So 500 times your investment. So you can't outright write off these unprofitable companies just because they're not quality, right? Like people think. You really have to look deeper into the company, find those companies that you really do believe are going to change the world in which we live, and take a chance on a couple. That doesn't mean invest your entire portfolio in growth stocks or in these, but just buy two or three. Like I said, $1,000 in Amazon in 2002 would be $500,000 alone right now. So you get a couple of these growth stocks that are changing the world, and I think it's smart to take a chance on them.
Yeah, I'm sure even Warren Buffett wouldn't say no to, to those type of returns. So I guess, the most talked about word at the moment that, I've heard of, and I'm sure everyone's heard of, is recession. It looks like there's probably the potential for a recession. The White House have almost, they've changed not the official definition, but I guess the definition that people had used previously. So what's your opinion on this? Do you think that we could see a recession in the next few quarters? And then if that were the case, how do you think that would affect the markets?
Sure. Well, we are. I think we are already in a recession. If you talk to anyone on the street, they can tell you prices have risen so much faster than wages. Rents are going up. Everything. We are in an economic backdrop or downdraft. The only problem is the NBER, which is the National Bureau of Economic Research. They're the ones that officially call a recession. But they don't use that 2 quarters in a row of falling economy, which we actually did do in the second quarter. We had 2 quarters of falling economic growth. They don't use that, so they have a little bit of leeway, and of course they're never going to call a recession just before the elections, right? So maybe a little bit of politics involved, but we are in a recession, and if we look at Deloitte data goes back to 1948 with the recessions, and it shows that the average between 10 to 20% drop in corporate earnings during a recession, right? Well, the problem here is if you look at stock market expectations, what analysts on Wall Street think earnings are going to be like for stocks in the S&P 500 over the next year, they actually have penciled in still sales or earnings growth. Right, they expect this year to do about $227 per share on earnings for companies in the S&P 500. Next year, it's about $245 That has come down from expectations of $250 for next year's earnings over the past couple of months, but obviously not nearly enough, right? It has not come down to the point where we're seeing, okay, yeah, we are in a recession. That recession is just now starting, and corporate earnings are falling. They need to fall quite a bit further, and obviously, any 3 to 6 or even a year period, stocks are controlled by investor sentiment, what investors feel about the market and how much they're willing to pay. But over that longer term, it's all earnings, because that is what you own as an investor. That is what you own with that share of stock. You own a share of those earnings. So as those earnings go, your share prices need to go along with it. And again, as those earnings need to come down further to better reflect that recession, those share prices need to come down as well.
Yeah, which it looks like we will be seeing potentially in the next few months. So
Yeah.
I guess, how have you positioned your own portfolio to prepare for that? Because I guess, as you mentioned, probably a lot of people who were in growth have lost quite a lot of money in the past year or so. And I guess there's potential that they could lose more if it just in the overall stock market. So what have you done for your own portfolio?
Sure. Well, in this kind of environment where we do have those bear market rallies and is really unknown and uncertain around the stock market, I really do like the kind of a barbell strategy. Okay. Again, for long-term investors, you can buy anytime. You can continue to buy stocks every month and just not worry about it. That is a great strategy, and a great strategy for a lot of people. For someone that gets maybe a little bit more risk averse, a little bit more hesitant or scared, panics out of the market, then this barbell strategy is a great one for this kind of a market, right? And what this is you've got, if you think about a barbell with the weights heavy on each side and then kind of just nothing connecting them in the middle, then on one side, you've got like a lot of growth stocks, right? A lot of growthy stuff, higher risk investments that are going to do really well in these bear market rallies when the stock market does jump up, 10 or 15%. And those are going to do well. Those are going to lift up your portfolio. Now, on the other side, though, you have more cash, bonds, maybe some like I-bond savings bonds that are paying 9.6% right now. Great investment. But you have very safe investments that are going to protect your money and protect that part of your portfolio just in case stocks do fall, and you can buy in at those lower prices, right? So it's a very, very two-sided portfolio. And what this does is it protects you from, I know a lot of investors got scared out of the market, sold their stocks, and now they're seeing, as we record this in August, stocks just had their best month in 19 months, best month since November 2020, up 9% last month alone, right? And so what happens is a lot of investors, they get scared out of the market, sell their stocks, and then they see it go up. They see it go up, 10%, 15%. And they think, well, shit, okay, this is the next bull market. I got to buy stocks. I got to buy my stocks back. So they buy in after 15% up. And if it does prove to be a bear market rally, they have just missed out on that 15%, bought stocks at those highs, and now they see the stocks fall again. Okay, so, completely frustrating. They're going to start losing even more money, and they're just going to give up on the markets, right? So what this does is it keeps you partially invested in the market with those growth stocks. Those growth stocks do better when the market rallies. In fact, some of those like PayPal, SoFi Technologies up 25, 28% over the last month. So outperforming the market. But it still gives you some money set aside just in case the market does fall further. So great strategy, that barbell strategy, to really take advantage of either scenario.
Yeah, and I think that's probably what a lot of professionals have been doing as well, trying to de-risk a little bit, but still, because you never know when it will bounce.
Sure.
Um, but I guess, what are the indicators you're watching? Because at the moment there's quite a lot of negative news coming out about the economy, about what's happening in markets. So,
Sure.
what would you be watching? If something changed, what would that be for you to change your portfolio? Maybe go a bit more into risky assets.
Sure. Well, really, why the market is rallying right now is on that idea of a Fed pivot. Okay, so the Fed has been very aggressive at raising interest rates to slow down the economy, slow down inflation, and the market is just betting that, okay, that's over now. The Fed is going to slow down. It's going to take a wait and see approach to let the market or let the economy cool down, and that's good for stocks. If the Fed slows down its interest rate hikes and slows down that, trying to cool the economy. Well, now we have to see that actually happening, right? So we've got a jobs report coming up here in the United States on Friday, expected to report 250,000 jobs created in the last month. That would be down from almost 400,000 the month before. So if the jobs market does start getting a little bit weaker, then that's obviously going to cool down the economy. That's going to slow down inflation because if fewer people have jobs, fewer jobs are being created, that kind of thing. The inflation report. So monthly jobs report's one thing. The inflation report that we get right on around the 12th of every month, that consumer price index, the CPI report, that topped out at 9.6% last month. Now that probably will start to decrease just because gas prices and energy prices and some food prices have come down so much over just the last month. The problem is, and I think that's going to be a kind of a short-term boost for sentiment for the market because that will come down this month, but it's going to be very, very much more persistent, I think, than people really expect. Inflation is going to be much higher because the jobs market is still very strong. We still see very strong increases in rent prices, and that's gonna hold up inflation for much longer than I think people expect. So I do expect the market to kind of come to that realization that inflation is going to be more sticky, more persistent than they expect, and that's going to weigh on stocks. But I would start, if that starts to come down to closer to 7-6% and stay there, or maybe come down a little bit further, that's what I would look at as a real confirmation that the Fed has been successful in bringing down inflation, and and stocks can move higher eventually after that. But until we get down to even as far as 5 or 6% inflation on that CPI number, then I think the market is still going to be worried that inflation isn't beaten, and the Fed is going to have to continue to raise rates to beat it.
That'd be really interesting to see where if we get to maybe 5 or 6% consistently, and say interest rates are at 2.5, 3%, whether the Fed will continue to push up or they're hoping that it comes down.
Yeah, they're expected to go up as high as 3.25, 3.5% already through the end of the year. I mean, even with a slower approach, they've done two rate hikes of 75 basis points or 0.75%, and they've been really good at kind of previewing that, at forecasting that, saying they're going to be aggressive at first, they're going to slow down, and the markets are really kind of waiting for that slowdown now. But they're still, over the next two meetings, they're still expected to raise rates by about 0.5%, which is kind of the market disconnect right here, right? So the market is ahead of itself. It's saying, okay, we're going to get that slowdown in rates, so we're a little bit more optimistic on the future. But the problem is, we're moving from almost 0 to 3.5% interest rates on the Fed funds rate in one single year. Long-term mortgages had doubled, since the beginning of the year. We are just starting to see the effects on the real economy from these interest rate increases. The weakening jobs market, the weakening housing market, things like that. And I think that's really the kind of the next shoe to drop, where the market realizes that the Fed might be slowing down its interest rate increases, but interest rates are still going up, and the economy is still slowing, and perhaps maybe going to slow faster than we expect it to.
Yeah, I guess once we see something break badly, that's where we could see Fed having to pivot. But then the challenge is if that's only if inflation has decelerated.
Yeah.
Yeah, so very interesting time to be an investor at the moment. And I guess, as you mentioned, you've sort of been investing in some very volatile times, and we've seen volatility over the last year in many different assets. So what advice do you have for people who, do struggle with that volatility, just do get very fearful about the potential of losing lots of money, and they might not make the right decisions? What
Sure.
opinions, what
Sure.
advice do you have for them?
The best advice would be just don't look at it. Okay. Just invest regularly. Use that long-term buy and hold approach where you've just got, maybe one index fund, maybe 3 to 5 ETFs, right? That give you a very broad market return, right? You don't even have to invest in individual stocks. Just put your money in those broad funds that are going to give you that market return. Set it up so you have an automatic deposit into your investing account every month that goes, even automatically into those stocks, and just do that. Just buy every month. If you look at any stock chart over the last 100 years, or the market itself, it goes up. We always get through these little recessions, these little bear market crashes, and stocks are still the best investment you can make on a long-term basis, right? So just understand that. If you get panicked and if you get fearful about the markets and about these short-term drops, these even 1 or 2 year drops, then yeah, just set up everything automatically and just don't worry about it. Do what you do best. Make money how you make money, and use that to invest.
It's so easy just to keep your sort of brokerage account open on your phone and just continue to look at the
Oh
money
yeah,
going down. So you just
yeah.
say close it, maybe delete the app so you can't
Because
make any
it
rash
is
decisions.
addictive, you know. Yep, it is addictive, and it looks like you're losing money. It looks like you're going to miss those retirement goals, those financial goals. So it can be dangerous. It can be a very dangerous point, but it can also be a lot of opportunity. You know, the best returns are made in a bear market. You know, these prices we're seeing right now, that is a 20% discount to where we were at the beginning of the year, right? So this is a great time to invest, even though it may be painful to look at your stocks and look at your portfolio and see that it's down 20 or 30% or whatever it is. It can still be a great opportunity if you have that longer term picture.
Yeah, and I guess everyone complains about, oh, price is too high. I'll wait until there's a drop, and it's just about taking advantage of the drops when they occur.
Sure.
Yeah. So you mentioned at the start of the interview that you've learned a lot of mistakes and from a lot of mistakes that you've made in investing. I think we all have. I guess, what are the greatest lessons that you've learned from your own mistakes that you can tell others?
Sure. Well, one, I think to have that portion of your portfolio that is just invested in that core portion, that, those ETFs, the index funds, and maybe, that 10 or 15 stocks that you're going to hold forever, no matter what. You love these companies. You think they've got great futures, and you're just going to hold those and not to touch that. Just invest every month. Use a little bit of portion of your cash each month to buy more of those stocks and that part of your portfolio, and just let that grow. Because again, that is the simplest, most stress-free investing you can ever do. And if you do have another portion of your portfolio that you can play with, have fun with, and follow the markets with, then that saves you from really touching and messing up this other portion. Best way to invest if you do have that need to pick stocks and try to beat the market, right? If you don't have that need, then just have that entire portion of your portfolio as that index investing and that long-term investing. That's the best thing to do. But if you do have that need, then just do it with a very small portion of your portfolio, 10-15% at the most.
Yeah, and that's for very important. So I guess you mentioned at the start that there's going to be some amazing growth companies that come through. They're already amazing at the moment. They have some great numbers. So when you analyze a company, what are the major drivers that you're looking at?
Sure. Well, I'm looking at some easy stuff is like sales growth, and operating margin. And what I'm looking at for here is, okay, so how much are they growing their sales? How much are they turning into operating profits from those? But not necessarily just for that absolute level, but compared to their peers, right? And you've always got to compare a company with its peers in its industry, with other competitors, because investing or comparing maybe a technology company against a bank just is not going to tell you anything, because it's two completely different growth rates, completely different business models, things like that. So you always have to compare a company against its competitors. Well, what you're looking for here is that company in the industry. So that growth stock or that that software company within the software companies within its industry, that is making higher sales growth. Why are they able to grow sales at 20 or 25% when the rest of the industry is only averaging maybe 15%? Okay, why are they able to make those faster sales? And a lot of times that can point to some kind of a competitive advantage, whether they have product innovations or they're able to deliver the product better, something like that, can point to some of those intangible qualitative factors. Operating margin, which is just the operating income divided by those sales, gives you that real core profitability of a company. And not only does it mean they're converting more sales into earnings, but also gives you that idea of qualitative, a qualitative company, right? The company with the best management that can turn those sales into more earnings and can be more profitable. So that's really where I start with a lot of things. You can look deeper into a company and look for stocks in industries that are growing. One of the best things you can do is look for those big universal forces, those big trends, 5, 10, 20-year trends that are really pushing all the companies in that industry, and really start with that, right? Because even if you don't pick the very best stock in that industry, since the industry itself is growing so fast, then it's going to kind of a rising tide lifts all boats, right? It's going to bring all those stocks in that industry up, and you're going to you're going to do well no matter what stock you buy in that industry. So yeah, you start with that top big picture, pick the industry with a really good growth, and then pick the best companies within that industry.
Yeah, no, it's just a 3-step approach to
Yeah.
doing that. And what are some red flags? I guess if you've seen you might see something in company and like, hang on, this doesn't look good. I'm actually going to steer away from it.
Sure. Well, debt is obviously always a big one. A lot of companies, especially older companies, a lot of the dividend payers, a lot of the value stocks, those out there that have maybe slower sales growth, right? They will try to grow the company by acquiring others, right? We saw this. This is the best example is probably with AT&T over the past decade. A leader in telecom, but then obviously, telecom isn't a growth industry. So they started seeing sales growth slow down and they thought, hey, we'll get into satellite TV, right, with DirecTV. We'll get into internet content and media with AOL Time Warner. And they paid tens of billions of dollars for these companies. And of course, the acquisition never comes out as well as they thought it would. It never produces the kind of earnings they thought it would. So they are now saddled with, 40, $50 billion worth of debt on these acquisitions, and the interest expense is just too much. They just don't have the financial flexibility to reinvest in the company, and the share price has lagged for the better part of 10 years for AT&T, right? It has just started to kind of come to a realization that wasn't a good business strategy, so they sold off those other companies and are now focusing on telecom once again. But yeah, that stock has gone nowhere for very many years. So that's one thing I would look at is that kind of debt or that acquisition strategy that a lot of companies use and just blow up the balance sheet with debt. So debt to equity, something like that. Another one would be, kind of specific to maybe dividends. You look at the payout ratio and see that a company isn't paying out, is paying out less as a percentage of its earnings relative to other stocks, relative to other industry players. That means it's saving more behind to reinvest in the company and grow the company and potentially grow those dividends. So that's always another good one to watch. Not necessarily a red flag. A red flag would be, if it was conversely paying out way too much of its earnings. So if it had a payout ratio very high, that would be maybe a sign of an unsustainable dividend yield.
Yeah, there's normally a reason that they have to pay those dividends for people that own the actual stock.
Sure.
Yeah, it's interesting. And have you had an experience in the past where you've invested in the company and that sort of bit you in the backside or something like that?
Sure. Well, I think GE, General Electric, is another good example of what can go wrong with a company, and it's so frustrating because this was a leader, a bellwether of the markets, and a great stock for so long, and the management has just mucked it all up, right? And you really did start to see it with kind of that payout ratio where the dividends started to be so much a part of the earnings that they couldn't reinvest in a lot of their projects that they needed to. So that was kind of a warning sign that the dividend would be eventually cut and the stock price wasn't going to go anywhere.
Yeah, and I think they were the biggest company at one point before the recession, and then
Yeah.
2008 recession, and now they've lagged so far, and they have to split up now. I think.
Yep.
It's plan, yeah, crazy to think. So, Joseph, thank you so much for your time. We've covered so many topics about recession, your own experiences, and everything like that. So, I guess my last question is, what is one message you'd like viewers to take away from our interview?
Sure. Well, yeah. Don't complicate investing if you don't need to. If you don't have that itch to satisfy, then yeah, it's there's nothing wrong with just index investing, investing in 10 or 15 of those long-term growth stocks, investing in those every single month and not worrying about it. If you do have that itch, if you do love picking stocks and following the markets like we do, then just have a portion of your portfolio set aside to where you can do that, and then have the rest of your money getting those market returns to meet your goals.
Yeah, I think that's so important for people to do. So, Joseph, thanks again for your time. And I guess, can you tell us a little bit more about Let's Talk Money? And I guess what you do there and what you're trying to achieve?
Sure. Well, a lot of it's just what we've been talking about here. Just talking about stocks, talking about where the market is going, how to make sense of all of this, and really sharing those different strategies. Right. I think that's really because every investor is different on their own needs, their own risk tolerance, what they enjoy doing. So I think finding that strategy that works best for you. There is no one single best strategy. So finding that one that works best for you and makes you the most money, I think is what I really love sharing and just sharing my own personal experiences with investing.
Yeah, awesome. That's great. So I'll put that in the description below. Is there anywhere else people can find your work, or is that the best place for it?
Yeah, got the blog mystockmarketbasics.com. It's really much more of a kind of a basic stock market tips and tricks and advice. Not quite as much stock picking as we do on the channel. Love to see people there, or really just join the community on Let's Talk Money.
Yeah, awesome. I'll put that on the description below. But Joseph, thanks again.
My pleasure. Thanks.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.